It's funny when I'm asked to speak about Mintz. I've been at Mintz for a total of this is my second day at the firm. There's not a whole lot I can. There actually is a lot I can tell you because I spent a lot of time considering a move here from my prior firm, and I chose among a number of firms who were foolish enough to think I might help them. No, in all seriousness, I'll tell you a little bit about Mintz, and I'm really just delighted to be here, and I'm glad you all could make it. I take it there's also an audience, an online audience that is fairly big, so I'm not sure which camera I'm supposed to look at.
Someone over there.
Okay, that's fine. So a little bit about Mintz Levin, or just Mintz. Actually, I think the name officially changed, or the reference is just to Mintz. The firm is about 600 lawyers. The firm is based. The headquarters office is in Boston, where the firm started, and we have offices in Toronto, Boston, New York, as well as Los Angeles, San Diego, and San Francisco. My attraction to the firm really was based on the focus of the firm in the following three areas, which are the areas that I practice in. Technology, and I think the firm is widely regarded as having a leading technology practice, as well as in the sectors involving healthcare, life sciences, and clean energy. And these are all topics and sectors, rather, that investors are really clamoring for. Technology for a long time has been a main focus of venture investing, and certainly it's a large focus, but not an exclusive focus for private equity investing. And because of a number of factors, global factors, as well as factors unique to our country regarding tax legislation and the Inflation Reduction Act, alternative energy has become a major focus for investors, both strategic investors as well as private equity firms. The firm has a very substantial focus in both venture capital and in private equity, and we represent a number of venture firms and a number of leading private equity firms throughout the United States. Of course, we also work with strategic investors, both in the United States and abroad. Because our offices are based in the United States, I would think, but my partners can correct me, that a lot of our focus in representing offshore investors is on their inbound investing. And also I'll say this office has only been around for how long? Since December, maybe?
In this space?
Yes, this space. So we've been in these offices only since December. The firm was previously at 666 Third Avenue. In fact, I think this is one of the first events we've had at this space of this size, and we're having our grand opening for clients on Thursday of this week. So you actually beat that. If you didn't notice, we were going to have this event at a different address in a different venue, and it changed. And it changed very recently. And the reason why it changed is because I called Marty about 2 weeks ago, and I said, Marty, I don't think I'm going to be at Troutman any longer, and I don't think they're going to let me in the door once I leave. So we're going to have a little bit of a difficult time with me being any part of a host or speaking in any panels unless I do it remotely, and I don't think that was the idea. Yeah, although I guess we could have done that. So, Marty was gracious enough to try to mobilize all of you and get you all to come here. Now, fortunately, it's only 2 blocks away, so it wasn't a major trip, across continents. And even more fortunate was that the team here at Mintz really, just worked so hard to enable this to happen, in advance even of our grand opening on Thursday. So really very appreciative of that. Now,
you're not mincing words.
That is correct. That's correct. And it's also funny. I see a lot of old friends here. I've spoken at a number of private equity oriented and venture capital oriented events over the years. And so I've seen a number of folks that I know quite well, and a number of other folks that I'll see later on today and tomorrow, who I also know very well, who I've enjoyed speaking with over the years. I typically speak about private equity and venture to venture capital sponsors or private equity sponsors. This is a bit unique because today, most of the people in the audience are family offices. And so I think it's worth noting some of the strategic advantages that family offices have over financial sponsors like venture firms and private equity firms. With all due respect to our friends from those sponsors, but you do have to compete with them. And so, so I thought it might be of interest to some of you just to hear about some of those thoughts. I work a lot with sponsors in auction contests where there's a fair amount of competition among investors to make certain investments, and those investments can range from venture investments to growth equity investments to full buyouts. One of the main issues becomes the duration of the investment. Private equity firms, venture firms typically have a defined duration. They will typically have a defined term of the fund, which can be anywhere from 5 years to 10 years. It could typically be extended for 1 or 2 one-year periods. As family offices, those of you who are family office investors, you have that very distinct advantage of providing capital of an unlimited duration. You don't have to exit. So the thought of people investing, you investing, relative or whether you're competing against financial sponsors, I think that's a major advantage that all of you have. You can talk to the founders of companies and the management teams of companies and explain that your capital is not necessarily going to be pulled out or transferred to another investor within a certain period of time. You also, often have additional funds to support growth for external acquisitions. The other thing is, some have the perception, I don't know if this is correct or not, but some have the perception that family offices are typically more passive investors in terms of getting involved with management. Management teams typically want to continue to manage. And so, there is that sort of fear, especially in the larger cap markets, that those private equity funds will come and change management. So just another advantage, and also in this difficult fundraising environment. And I think we're seeing financial sponsors really have some challenges these days for the past, let's say, year or so, maybe 14 months in raising capital. Family offices don't necessarily face those same challenges. So, just a few points to note. I'd be curious if any of you have any sort of questions about. I see a question already.
Sure. One of the things I like you to talk about is the fact that families have been crowded out by a lot of PE firms because PE firms have institutionalized the process. Many families have gone out away from the Tommy Lees of the world and whatnot over the years. Pricing structure, access, minimums, etc. And they've gone the route of direct co-investments, etc. What's the perils and process of pros and cons of either of those?
Well, it's a great question. I think it's important for family offices to be more institutionalized.
You should repeat the question for the people online because I had trouble hearing it.
Sure. Well, here, why don't I give you the microphone so you can ask the question yourself?
Sorry, I heard it, but
I'm not that bashful. So over the years, families have been pushed out from the PE side because the institutionalization of PE has gone to the endowments, foundations, and whatnot. And many families, whether it's because of duration, because of et cetera, structure, size, minimums, whatnot, have decided to go directs or co-invest with people that they know and whatnot. And so I was just curious about the pros and cons of how that is evolving from a return point of view. Because obviously PE has done very well, anywhere from 700 to 1,100 basis points over a 5, 10, 20-year term versus public markets. Just curious how you look at that. Okay.
Well, first of all, I think there are increasingly fewer opportunities for family offices to co-invest because private equity firms will typically offer their own investors co-investment opportunities.
Right.
And so, frankly, that's a big reason why certain funds, or rather certain investors, invest in particular funds because of the history of the opportunity to co-invest. Not only is it the opportunity to co-invest, it's the opportunity to co-invest with lower carry and sometimes without even a management fee. So I think family offices these days just have much fewer opportunities to participate with financial sponsors in co-investments. I also think that if family offices are going to compete effectively for investment opportunities, they have to be more institutionalized. And the big disadvantage that family offices have traditionally had, and I've worked with very small family offices, and I've worked with some of the largest family offices in the country. The larger ones have institutionalized their family offices. They not only have internal analysts and people that are responsible for deal origination, they have operating partners. They have a plethora of a whole staff. They even have a legal team in-house for some of the larger family offices. But by and large, many family offices lack, they haven't developed this sort of institutional framework. As a consequence, they don't see as many transaction opportunities. They haven't developed relationships with the bankers who are identifying these opportunities in the first place, so they're not participating in the processes. And when they do participate in the processes, they often don't have the infrastructure to support the thorough analysis that their counterparts, being financial sponsors, will conduct, as well as the diligence. So I hope that.
And one of the ugly sides of family-to-family co-investments is that you need exit strategy. What happened? Because the exit strategy on the PE side can be a lot easier than family-to-family, where there's competency issues and trust issues and things of that nature.
Well, I agree, but again, in terms of exits, I still believe that providing longer duration capital is a huge advantage for family offices. That's one of the reasons I think that we're seeing certain longer duration funds. Several leading sponsors have created funds that have 15 and 20-year durations. I represent one client in the infrastructure space. They invest in alternative energy. I spend a lot of my time focused on renewable energy. And they have a fund of unlimited duration. And they represent, their investors include several of the largest pension funds in the world.
Alberta, Ontario, yeah.
Yes, but even more than that, European sovereign wealth funds and European funds, that all these investors want is a place to put their money for a long period of time. The pension fund managers don't want to have to deal with reallocating every few years. So I think that's a very significant advantage. Marty?
So I have two questions. One is, do you think that the changes in the credit markets, the increase in rates, will impact these private equity firms, which have been kind of like using cheap credit to choose the return, et cetera, number one. And then another one is, just give us some do's and don'ts for family offices who want to get involved in the private equity game.
Well, I think the jury's still out about whether an increase in interest rates, how that is impacting the ability of financial sponsors to do deals. They're still doing deals, right? While capital raising is experiencing some challenges, other than I would say at the mega size funds who are still raising capital in droves. I think that the ability to deploy capital is still very robust. I mean, I'm still seeing a fairly robust market. Now, I tend to focus more on the middle market and the lower middle market in terms of size. Transactions ranging from 25 million to $1 billion, which is still middle market. But I'm not sure. I'm just not sure. I know that I think it impacts valuation. So in talking to my clients, if their cost of capital is higher, then they have two choices. They can use less leverage, which completely changes the return profile of a particular investment, or their returns are going to be lower. It really, if they're interest rates. I think somebody mentioned earlier today that the aggregate increase by the Fed in the discount rate has been 450 basis points in the past year, which I actually thought it was more, and I still expect it to go higher. In terms of do's and don'ts, for family offices, I think that the main thing is something that I already covered, Marty, which is that I think if family offices are going to compete effectively with private equity and venture funds for investment opportunities, I think they have to have the same or similar sophisticated infrastructure that these PE funds and these sophisticated venture funds have. And that requires an investment in people, and it requires an investment in resources, and it requires a different outlook. I think they have to professionalize themselves if they're really going to compete effectively. I am constantly amazed at how sophisticated some of my financial sponsor clients are. I mean, the talent, it's some of the most talented people I've ever met work in some of these funds that I represent. And they have deep experience. There's often, a recent trend. When I say recent, let's say over the past 6 or 7 years, I've seen an increasing trend of financial sponsors to be industry or sector specific. Years ago, I feel that funds were much more were focused more broadly on a variety of industries. And now, I think in part as a result of competition for investments, we're seeing sector-specific funds, whether it's a fund focused on technology or certain aspects of technology, or it's a fund focused on biotech or life sciences or healthcare or alternative energy. We're seeing those funds that are coming out there just focused on those specific sectors. Family offices have, my advice would be for family offices to figure out what they're really good at and to chase those opportunities.
And maybe I have a question for Steve. He's in the family office, and there's other family offices here as well. And you can just redirect it. But the question is, a lot of family offices have kind of like these barbell portfolios, right, of their investments. So private equity is not a huge part. It might be 10% or 5% of their portfolios. So then the question is, when you're dedicating a lot of your staff to a small part of your portfolio, and then the rest only has like a CIO, you have to kind of evaluate it. So you're recommending that family offices adopt the architecture that a lot of PE firms have.
To the extent they
endowments, foundations, those kind of people haven't necessarily the best policy to do it Wesleyan, so I know that. But those kinds of setups are very different than a 5-person family office that has 1 or 2 people in the investment side trying to get access to that.
I agree.
The other side is that the term family versus the term institution has a lot of emotional and a lot of other baggage around it. And that tends to be something that relates to how they play the private equity game.
It's a riddle, right? It's really is.
And you really got to be careful about how that's done, because they may say, hey, I'm out of this next year or 2 weeks from now. I'm firing the guy or gal that runs that for me. That's a big difference than institutions that have an investment policy and the longer line pieces.
But I think there's more opportunities than ever for family offices that happen as a result of interest rates.
Well, yeah, no, I
It's
agree.
more difficult for PE firms to raise next funds. Just happened in 2008 because rates are higher.
Yes.
So that should leave more opportunities for
It should,
family
but
offices
then how do you buy the best talent out of those firms that you're talking
and
about?
convince them to stay.
Yes.
So, those are like as I said, it's a riddle.
It is. I don't have an answer for that. How do you attract talent anywhere? Either cash or carry or something.
Interesting deals and pay more. But what I recently read a KKR report that was released at the end of last year, and it mentions that alternative investments have taken a larger piece of the family office in high net worth investments. So So the equities went down from 40 or 50% all the way down to 30%.
So that's because both the stock and bond market cratered last year. I guess the performance.
So people are investing more in private equity and not that, what I'm saying is that it's not the 10% anymore. It's probably a 15, 20, 25, and then private real estate has taken a big chunk of that. And you see private real estate as income growth or opportunistic, depending on. Exactly. So that's.
Question over here?
Go ahead.
Want microphone?
Yeah, of course he does.
One of my
We're
offices.
talking about Camille. Of course he wants a microphone.
Andrew and I, we became friends many years ago. The conversation when we talk about family office, we should be more specific on breaking the family office, and that's what we do in Europe when we do conferences. There are family offices under $150 million, and there is 100, and then from that number up to $1 billion, and then the families of multi-billion. So for an attorney specialist to answer you, I'm not defending you, just because the answer will be different, because the level of tolerance is different, and the risk taken is different. And then the family of $150 million, how much of that 150 is liquid? Is it all invested? You know what I mean? Marty, you the expert.
No, it's a riddle, right?
You see what I mean? So when we ask an attorney a general question, the attorney is going to give you a general answer. It is a case by case. And I know there's so repeated many times, every family is one family, which is true because every investor of yours, every one of you is different from the other. But the liquidity and also the risk tolerance are very important when you say that. For example, for myself, I'm only alternative. I do not invest in bonds. I do not invest in the stock market. I don't care how much is the return, and then if someone approach me and say, Camille, the internal rate of return, I said, don't start the conversation with me like this. Let's start from the fundamentals. And then I tell the co-investor, if he's a partner, family office, I don't invest a lot with family offices for many reasons, with all due respect. And if they don't invest with me, it's fine. Is the structure of the relationship and also the sectors that I do not invest in. I always say that to people. I don't invest in cannabis. I don't invest in tobacco. I don't invest in liquor. I don't invest in pork. And if anybody want to know, you live in New York, you know why. Fair?
Fair.
Thank you.
Thank you. We got about 2 minutes.
Yeah.
I think unless anybody has questions, I think we can.
One more question.
Actually, Camille said most of what I would have said, but I think that, look, I come from it from the perspective of we have a family, we have our own family office, and I work in the business. And I do think everyone's objectives are different. And I think if you're connected well enough in this industry as a family, you can get into any fund you want.
Correct.
So I also think endowments, foundations, institutions can get into any fund that they want if they know how to play the game.
Correct.
And so I think it's about setting objectives, being clear on what your objectives are. And as Camille just said, I always lead with what I don't invest in. As from our family, we don't like long only. We don't like ETFs. We don't like traditional fixed income. We think there are better ways to skin the cat, and we lead with that. But the rest of it, if you're sophisticated or you have sophisticated advisors, shouldn't be that complicated. And I think people make it more complicated than it needs to
Find that
be.
families that have 100 million with very level of sophistication can do it very well, and families with 2 billion, they don't know what the hell they're doing.
But that's their fault.
Yes,
There's a lot of terrific advisors
absolutely.
that navigate this so well.
I know.
Listen, I just wrote a big check to the IRS last night after a very bad year. Writing the check didn't feel good, but when I thought about what could have happened, it felt very good. And we work with advisors.
Oh, we do too.
It didn't feel good to me.
It feels better than not writing it.
I agree.
My father always said, if you're paying taxes, it's a good thing.
Well, thank you, everybody. I'll be seeing you throughout the conference. And, appreciate the opportunity to speak to all of you.